Kevin Nicholson thinks he's still with us, Global Fixed Income co-CIO over at Riverfront Investment Group, still with us here on Bloomberg Markets to Close. Kevin, let's talk about some of those inflation expectations and, more importantly, what your general expectations are and whether they actually sync up with the Fed.
Well, Romain, I think that when we think about inflation, we think that inflation is going to move largely because of wage increases. And what we're seeing thus far, we haven't seen any wage increases much. And so where you're seeing the wage increases have really been at the lower wage jobs. And so we don't think that that is going to push inflation to the point that it's not transitory. So for us, we're not looking at inflation as being an issue. We also believe that, technology is going to continue to be the great deflator, so to speak, with the innovation piece. And because we live in a global economy now, we believe that there's always going to be that low-cost provider. So there's going to be instances where we're going to have prices go up in certain industries, but they're also going to go down in other industries. And so at the end of the day, we think that it's going to level itself out.
So you buy what Jay Powell's saying, you think inflation will be transitory. Do you think, though, that he can continue a cohesive viewpoint coming from the FOMC in its entirety and indeed keep the markets on side, believing that they will too see it as transitory?
I think that he has a 3-month window, Caroline, and if he can keep them on point for the next 3 months, I think that he will have succeeded. Because at that point, I think that the markets will be ready for the taper talk. But it will be very interesting. We all knew starting in March, that we were going to see the base effects come into play with inflation. And so we expected to have several months of very high inflation. And so I think that we've gotten that out of the way. And so it will be interesting to see what the Fed chairman has to say. But I think that he will be able to keep markets at bay for at least through the summer.
We heard from Paul Tudor Jones speaking out this morning, and he said if the Federal Reserve is really nonchalant about inflation data, it is for him more of a green light to bet heavily on every inflation trade, basically do the opposite of what they say on Wednesday. Are you in that camp as well?
No, I'm not there yet. And I may be totally wrong, but again, I'm not ready to throw in the towel and say that this is not going to be transitory from everything that we follow.
All right, so let's go back then and circle back to where we started here, Kevin, and that's the idea that, yes, you are a fixed income investor, as much as you may like to be somewhere else. When we talk about the traditional setup of a portfolio with the 60-40 or however people want to split it up these days here, do you think that given the changing rate environment or the expectations for a changing rate environment, there is some room for people to actually expand that 40 or expand whatever that percentage is now back up into 40?
I don't think that there is a lot of room for the expansion of the fixed income portion of the portfolio at this moment, to be quite honest. We continue to lean our portfolios towards equities, and because there's just not enough yield to generate the appropriate amount of income that people have become accustomed to in your traditional 60-40 portfolio. So I think that people are making the adjustment by adding more to their equity portion of their portfolio, and I think that this will continue for the near term at least.
You're not interested in high-yield bonds tied to crypto?
No.
Don't take the bait. Don't take the bait.
No, I'm not taking that bait.